Hello and welcome to yet another episode of Market Makers. The markets are on a bit of a frenzy, and therefore it makes sense to get in some valued voices to come and talk about how is it that they are approaching investing in the current scenario with all that's happening in the globe, all that's happening in India as well. And somebody I regard very highly as a very avid stock picker, but an astute market watcher as well, Basant Maheshwari, needs no introduction, joins me right now on this forum. Basant, so good having you. Thanks so much for taking the time out. It's a bit of a frenzy, right, Basant? I mean, everybody talks about how valuations are looking rich. Every single day, I have a guest coming in saying that valuations are expensive. And every single day, I have FIs coming in and pouring in yet another 500 crores, which takes care of all valuations, all kind of negative news that could come in from around the globe.
Thank you for having me, Neeraj. Good to be with you after a while. See, bull markets, tops and bottoms are made by the emotions of the participants and not by numbers on a balance sheet. So February valuations were good, but emotions weren't there, and now the emotions are there. So, one thing which I've learned is if there is a bull market on, and this is not a bull market according to me, I think there are some segments are in super bullish mode, but overall the entire market doesn't seem to be giving you the signals from the fundamental side. But there are segments where you can pick your stocks. So what happens here is valuations would look expensive, but market pays for growth, market loves growth, market is intoxicated with growth. So the sectors where you can see predictability, surety and certainty, I think they are being bid up several times ahead. And you know what happens after 3 years of slack, earnings, the base effect becomes very favorable. So, if a guy who's failing his exams almost 3 times in a year and fourth time he got 60 instead of the 30 that he was getting, you say he's 100% improvement here, but the 60 is still just 100% above 30. So somebody else in the class is getting 90, but everybody gets excited about it. So I think there are several segments in the market that are having the base effect working for them, and some of them genuinely look like leading the next way out for us. So that has to be seen.
You think this intoxication, as you rightly said, will last?
The intoxication will last as long as the growth lasts. So in an economy, see, let's do this basic finance thing. Normally we say 100 divided by the interest rate should be the P. That's a rule of thumb. And rule of thumb doesn't work anywhere else except in the classroom. So if we can just extend that, so interest rates across the world is right now 0, for example. So 100 divided by 0 is infinity. So you don't say P is going to infinity, but the markets, now people will say, this is a liquidity-led bull run. So tell me one bull run which wasn't liquidity-led. You can't buy stocks with credit card. You need real cash. So that's what's happening. So you can't complain about liquidity. Liquidity is an essential thing for a bull market. Like Nikunj always says, liquidity is mother's milk for a bull market. So I think that's the way to go about it. And there's so much money chasing. So even if you get 20, 25, 30% consistent growth, there's enough money in the world to bid stock prices up. So especially the ones which have certainty, surety, and those type of things.
Yeah, so the other thing is, Basant, an argument that I hear from a bull or from bulls, if you will, is that, hey, the valuations might be expensive, but where else does this fund manager sitting somewhere in SFO or New York have the geography to park money in? Almost everywhere else, everything else seems to be either crumbling or in a stage of uncertainty. India and a few select markets are the only bastions of growth, so to say. So money will keep on coming. Is that a reasonable assumption?
No, we've heard that theory before. Remember 2008, we used to talk about, coupling and decoupling and all of that. But my sense is valuation is one perspective to it. What kind of growth are you getting vis-a-vis that valuation? That is more important. So you could have a 50, 60, 70 PE stock trading at abnormal valuation, and if there isn't growth, people aren't chasing it. But if you got a 40 PE trailing and the company is assuming to be, it's assumed to be growing at 40, 50%, then the party remains in vogue as long as the music is there. So once the growth stops, the same story again. So then it's going to stop. So I don't think people come for valuations because they come for growth, and growth gets you in, and growth is never cheap. So the valuations appear to be high. I think it's okay as long as you can make a broad estimate as to up to how long the growth would continue. And that's the big thing. So I think obviously it isn't easy to make money in the market. Otherwise everybody would have been putting money in the market and banks wouldn't have any fixed deposits and savings account. So that's a broad call we have to take. I think overall, it's not the big India theme according to me, if you ask me. It's, yeah.
No, sorry, finish your point. Then I'll come to my question. The big India theme you're saying.
No. Right. I was saying, the way we showcase our country as if this is the only place. Obviously, this is the only place. But people don't come to you because you're India. People come to you because you find pockets of abnormality in growth over here. You find sectors that are under-penetrated, sectors that are taking market share away, and sectors that are growing. I think that brings the money in. So nobody comes to India on a top-down approach like we used to say before. But people will come to us if we can show them that this is what we are doing. So I think that's a much more wider way of looking at it.
True. Okay, so let's talk about those pockets, and we'll start off with that before we move on to the other things. I think headline reforms, as and when they get passed, will probably provide more tailwind, and we'll get to that. But the talking about rewarding growth, Basant. I mean, what an Asian Paints or a Bajaj Finance, or even slightly, compared to these companies, slightly second-rung players like a Capital First or a few others are showing, is that if you are promising northwards of 20-25% growth for the foreseeable future, people don't mind paying you 45 PE or 5 times or 6 times price to book. That used to be the territory of the Grah Finances and the HDFCs of the world. It is now starting to percolate to a bunch of other stocks.
No, that's correct. But if you look at them, except for this, when I sit down to create a portfolio, the first thing that comes to my mind is how much percentage of the portfolio can you put it into a sector? And if you just look at it that way, except for the NBFCs and the private financials, you can't find sustainable growth anywhere else. That's a problem as far as I'm looking at a portfolio, because now this is not a recommendation at all. We're just discussing stocks just to elaborate the discussion here. Let's take an Eicher Motor, for example. It's growing at say 40%, 30%, 50%. So the sale of their Royal Enfield is still lesser than Pulsar. So if in 2 years, if Royal Enfield becomes almost equal to Pulsar is a mass market product. So Royal Enfield is a premium. So premium can't become more than a Pulsar, right? I'm not creating a bullish or a bearish view. But what I'm saying is Royal Enfield finds itself new ways to grow by going outside India. It's a geographical diversification. So these are companies which you can buy for 60, 70 PE, and they will remain there as long as the growth comes in. Coming back to the consumer durable space, the financing space. So you have companies that are delivering at this base, 30, 40, 50% growth. See, 2025 isn't good enough. We say 2025 because 2025 looks very good, and 80% of portfolio managers underperform the indices. So I think the point of asking for 2025 is that you can't pay that kind of PE for 2025. If you are paying higher PE, you have to have 30-35 growth, and 30-35% growth cannot be predicted for 5, 7, 10 years because trees don't grow up to the skies. Sometime they will have to be cut off. So I think the kind of frenzy we are seeing is because the opportunities are very small and they aren't too high here. So it's about money chasing these things.
Yeah, clearly showing. I mean, the money is chasing NBFCs. Basant, what are your thoughts here? Now NBFCs is such a broad basket that there are specific pockets within this NBFC space as well. There are those microfinance institutions. There are these lenders like Bajaj Finance and Capital First, which have, in a manner of speaking, invented a lending mechanism of their own, which is friendly to the customer and friendly to the companies themselves as well. And then suddenly this spate of brokerage stroke NBFC names have come to the fore. I mean, some of them have housing finance to themselves, some of them have private wealth, which is doing very, very well. All of them have a marquee investor or the other coming in and putting in money for the next 5-6 years. It's a wide basket. Almost everything has the promise of growth. What does one bet on? Because there is only as much of NBFC that you can have in your portfolio.
See, let's take a broad call here. I mean, if you got the sector tailwind with you, 50% of your investing problems are solved. So what's the sector tailwind in NBFC? NBFC as a percentage, I think, is 13% of the total credit in India. So in developing nations, it's about 26-30%. So that's one way to go. It doubles up. What has the government done? Jan Dhan Yojana, Aadhaar, all your subsidies now come to your bank account. So the guy who wasn't willing to open a bank account has suddenly been forced to open a bank account. So that that in one way is transferring the black money into the white thing, because once you have a bank account, you go and save money. So that's the tailwind. I'm talking about the tailwind thing over here. So you have these two things. Then you have 1,500, I think, what's the per capita income? I think $1,500. Let's assume it that way right now. So roti, kapda, makan and cable TV, you've got that. So once you move above that per capita level of income, then you want to borrow a little for your future also, right? So that borrowing gets up. So if you had a per capita of $700, you just had enough for roti, kapda and makan. Who would come and lend you money? So once your per capita hits the $2,000 kind of a bracket, I think the capacity of the citizens to borrow against their future income increases. So that creates, because NBFC has to lend and also it has to recover back the money. So I think that's going there. Now in NBFCs also, like you said, there's a plethora of, you can just pick it up. Housing finance, you have consumer durables, and you have the MFIs, and then you have the, the gold loan companies, anything. So if you look at it that way, I think the frenzy is on, as it appears to be. But where else do you find companies delivering year after year, quarter on quarter? And look at the biggest consumer durable financer, 8, 9, 10%, 7 to 10% NIMs with minimum. See, the problem, why do you need a 6, 7, 8, 9% NIM? You need a net interest margin so high to take care of your bad loans. So if you can control your bad loans and still make 8% net interest margin or 7% net interest margin, I think you got a winner in hand. So I think these are the things, but they have been bid up. You have to look for the kind of companies that still are in the smaller stage, but it doesn't mean that the big ones wouldn't grow. I think the entire sector is growing. The problem that we face as investors is how much to buy of these. So I think too much of a good thing can be wonderful. So that's how it is.
I know, Basant, that you are invested in the microfinance stroke, companies which are probably becoming SFBs. Now, I don't want a recommendation here by any stretch of imagination, but if you can explain your rationale as to why is it that you may be liking an Ujjivan or an Equitas or an SKS for that matter. There are a couple of others too. Satin Credit Care has caught the fancy of a lot of people. Why do you like this space?
Same thing, the tailwind, not a recommendation like you said. The government is forcing people to open accounts. And if you just go and see what they have done, one of these companies had a bad mishap in Andhra in 2011. Then the regulator came in. Now the RBI controls them. You've got the Mudra Bank who finances them. And you've got these, all of them, the tailwind, the growth. And apart from that, it's about the rural economy. I'm not saying you buy them because monsoon is good this year, because you don't buy a stock for 1 year. You buy a stock for a trend, and trend is normally 3 to 5 years. So if you look at it that way, and look at the market cap of the small finance banks stroke the microfinance, I think it's not even 20,000 crores out of the total market cap of the Indian stock market. I mean, so 20,000 crores, you're getting the entire segment here. And how many MFIs do you have over here? I mean, 7 to 10 of them are converting into a bank, 9, 10 of them. And that is 70% of the microfinance thing. So some people tell me if they grow at 40%, 50%, they're going to exhaust all the entire growth of this sector over the next 3 years or the next 5 years. But I think in most of these cases, the estimate of the market size is itself deceptive, because you don't know what the market size is. How can you do a survey of the market size for people who haven't just opened bank accounts? So I think the growth continues there, and its valuation isn't too expensive at all. If you look at these, the 3 times book or 3.5 times book, 8, 9% NIM, and once you become a bank, the 10% cap goes away. So the real fear was, if you become a bank, you have to do SLR and CRR. So your 12% cost of borrowing comes to 9, 9.5. The cap goes away because you can make more than 10%. The RBI says you can make only 10% for an MFI. So once an MFI becomes a bank, you can make 12%, 13% also. But obviously, more money will come in. So those are the things. So it was a broad theme. I didn't think that we were going to get it so well, but it just rocked ahead, and now it's happened. So it's started, and we're holding on. I mean, there's no need to sell, and because it's gone up a bit. We've seen this before. Stocks can go into overvaluation territory and remain there. Question is, it has to be backed by earnings, and for the moment the earnings are coming in thick and fast, so no problem there.
Yeah, earnings are certainly coming thick and fast for those pockets. You've been known to pick up some very unusual themes as well in the past. I mean, I know of a number of examples from a condom company to a few others, because you saw some very interesting earnings back possibilities out there. What has struck to you as great, aside of NBFCs? What theme do you think is showing that promise of an earnings growth for the next 3-4 years, 5 years, and therefore you're willing to bet out there?
B2B pharma companies are there. But the problem, Neeraj, which happens is when you want to diversify a bit because you think, you want to diversify all eggs in one basket and what happens to the basket. I think most of the time diversification dilutes your returns, because I've always found that my top 80% of the portfolio has been doing phenomenally well, but the bottom 20% you get stuck somewhere here and there because you just wanted to buy that. So B2B pharma companies are very good. Now the problem there is, unless Lupin and Sun are on a roll, the B2B pharma companies cannot just go like that. So there has to be a sector tailwind, a sector has to be in fancy. But still, we are invested in B2B pharma companies, as you know, and that's one of them. Then a few here and there, offbeat ideas. So you buy a few of them, you buy a small allocation of your portfolio. If the company delivers and if the stock price moves up, see, stock price moving up is also important for me. I cannot say I can look at a stock which doesn't go up for 3 years, because stock price moving up gives you confidence. I mean, how can you say that I'm a long-term investor and it doesn't matter to me if a stock doesn't move for 3 years? I'm not in that camp. So I'd like the stock price to move up with earnings. If the stock price moves up, then we put in more. So the initial space is there. So I think that is how it goes.
Okay. Recently, we've gotten the news of more FDI into various sectors. What we've been very, very recently been hit with is FDI permissions in bourses coming in. A lot of talk of maybe commodity trading also starting at some point of time, so on and so forth for institutions. Are you bullish on this space? Because we have one existing player. We have arguably the largest or the most active stock exchange possibly coming out of the IPO at the beginning of the next year as well. Are you bullish here?
Not the stock exchange, but the participants there. But again, they are the extension of your NBFC theme if you look at it that way. Because even brokerages or mutual funds or AMC companies, they're all extension of the NBFC. And here you get a complete package. Like for example, you got a brokerage, you got an AMC business, and you got the housing finance also. So you get one of them. So I think we are not invested there obviously, but I think they will also do well. But the stock exchange, stock exchange cannot grow at 20-25% for longer periods of time. They'll grow at 12-15% that way. So I think that's a solid investment, but it lacks the X factor of growth. So even though it's a phenomenal investment, you can just buy it, and if you want to leave something for the grandchild, buy the stock exchange that's coming out. You can just leave it and forget it. It's going to do far better than a bank FD, far better than an Indira Vikas Patra or a Kisan Vikas Patra, if that is still available in the market, I don't know. But it wouldn't make a lot of money in a very quick time. So we try to do that. We lose some, we make some, and it's okay as long as we win more than what we lose.
Since you are not invested in that space, I think it gives me the confidence to ask you. You mentioned about a brokerage stock which has got broking and housing finance and AMC. I believe you were referring to Motilal Oswal. The numbers out there were rock solid, and the thing that I saw, Basant, was that broking revenues went up 20%. So it's not just that these stocks are now at the mercy of only the other businesses coming in. Broking seemed to be doing okay. It's come in okay for a couple of other smaller names as well, which have declared numbers. Are you bullish on this broking stroke NBFC space?
No, they look good. We don't own them. Their housing finance subsidiary is doing very well. I think it's called Aspire. And even the brokerage business it's a franchisee-led model. So if there is a downturn, they don't carry the operation cost on their head. So I think they're doing fine. I haven't seen them recently in detail, but I just have a chance to look at the flashes that come on TV, and off and on you look at them. But see, if an economy has to do well, you have to get the JP Morgans and those kind of companies. So these are all desi, one of them. One of them can become huge over the next 20, 25, 30 years. And I think that's the way to look at them.
True. Where are you on the private bank versus the PSU bank argument right now? I mean, valuations in favor of PSUs, albeit they have moved up in some cases almost 100% from the lows. But private banks are extremely rich right now. Where are you on that argument?
See, the PSU banks is like the child I told you who fails for 3 exams, gets 30 out of 100, and at the 4th he gets 60, and then you say they're 100% up. So for the last 5-7 years, people have been trying to say, I want to buy 0.7 book, I want to buy 6.6 book, and suddenly you found the book was disappearing itself. A 10% gross NPA with a 10 times leverage means your entire book is down in the dumps. So even though PSU banks have done well, they continue to do well because people were short on them, the hedge funds were, it was a classic trade, go long the private banks and go short the PSU banks. But this can't continue for 2, 3, 4 years. It can continue for a while that way. Private banks are the steady things, you make their 18-20%, you got a ton of money, you want to manage it well, you want to make very good returns, you make 18-20% by the standard 3-4 names, the 4 standard names, so you do that. But the problem in the private space now is, I don't own HDFC Bank, so I can talk about it. The FII cap, that holds it back. So you wouldn't like to be holding something where the FIIs can't buy. So in the private space, because the market cap is 1 lakh crore, 2 lakh crore, 3 lakh crores. But if the FII cap is there for a stock, which has a market cap of say 4,000 crores, because a couple of stocks that I own also have an FII cap, they're in the NBFC space. But the market cap there is 2, 3, 4,000 crores. So one mutual fund who wants to pick up 5% of the company, 300 crores worth, he can move it. But Indian mutual funds don't have the power to move an HDFC bank. You need the white skin to do that. So I think that's the distinction over there which we can put in.
Okay, what about the recent, the space which has kind of gotten clobbered because of concerns arising in growth, IT, steady businesses, tremendous cash flow generating capacity, proven over the years, somehow faces a probable cloud over the business which nobody has been able to tell me with certainty that yes, there is a problem. People believe there is a problem. Nobody's been able to say with certainty that I guarantee you there is a problem and the growth rates will diminish. What do you do here? Because valuations are probably in their favor after a really long time.
No, but we don't follow IT that closely. But I can give you a very broad sense here. These are the stocks or the sector that have had their run. They were young about 15 years back. Now they are probably into retirement mode. So they'll take you want a pension income, they're the pensioners for us, I think. They'll grow at 12-15%, you make that kind of money. And you can keep switching between TCS and Infosys and HCL Tech and Emphasis and this and that. But overall, there's no magic to be made in the big companies. Smaller companies, you can find your bets anywhere else. But I think trying to push them into running at 100 meters in 10 seconds, I think that's not going to happen because they've had their time before. So this happens every time. 2000 was the time for the ITs, 92 was cement, 2008 was infra, 2000, between these we had the consumer boom where you had the underwear company going up 40-50 times and you had this and that going up. 2016, I don't know, maybe it's the time for the NBFCs, I don't know. So I thought it was housing finance earlier. We still loaded up on housing finance, but the horses have changed a little bit here and there. I think it could be the MFIs, it could be anything, but I think NBFC as a space could do dramatically well over the next 2, 3, 4 years as long as they continue to grow at 30-35%. So IT for that matter, if you want 12-15%, I think you can keep switching here and there. So that's how it is.
Fair call. One last question. The big dark horse that you believe that one should monitor. I mean, one theme that need not necessarily turn out well, but if it turns out well, could actually give bumper returns.
I think just for the sake of catching a horse which is dark, we shouldn't catch it. If a white horse does well, why not bet on the white horse? I think the MFI is the white horse.
Irrespective of the color. Okay, so
why look at the color? Let's not be racist.
Okay, fair call. Basant Maheshwari, so good chatting with you. I think the sum and substance of this is you look at places which are giving you growth, certain growth, and probably NBFCs are the space to be in. So good chatting with you, Basant. Thanks so much for taking the time out and being with us today on Market Makers.
Thank you.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.